Hey, what's going on guys? In today's video we will discuss Elliott Wave Theory. Since this particular theory is somewhat confusing, especially for beginner traders, I'm gonna try to explain it in the simplest way possible. So let's begin. The Elliott Wave Theory implies that the repeating price patterns that we see in the markets represent different types of human behavior. So if you think about it, the masses act like a herd that tends to follow the major trends taking place in various industries, such as fashion, social media, news, and of course finance. Using the Elliott Wave Theory based on this behavioral pattern of masses, traders and investors can project future possible moves in the markets, reversals for example. So let's learn about the theory and ways we can use it to make better trading decisions. The basic idea here is that every directional price move in the markets, especially long-term ones, consist of repeating waves that are representative of different types of human behavior. Greed, fear, and euphoria are all included in the list. Ralph Nelson Elliott, who came up with this theory based on observations, classified these waves into two categories: motive and corrective. These two together create a full Elliott wave structure. Let's examine each category in detail. The first half of the full Elliott wave structure, or the motive part, always moves in the direction of the major trend of one larger degree. For example, if the major trend on the monthly chart is to the upside, then the direction of the motive wave we can see on the weekly chart, for example, should also be to the upside. The motive wave itself consists of 5 smaller subwaves that can be divided into 2 types: impulse and corrective waves. Take a look at the complete diagram of the motive wave. The waves 1, 3, and 5 are called impulse subwaves, and they align with the general major trend. In our case, it is an uptrend. The wave 2 and 4 are corrective subwaves that go against the major trend. There are 3 basic rules that must be satisfied for the motive wave to be valid. Number 1. The corrective subwave 2 cannot go lower than the beginning point of the wave 1. Why? Because in trending markets we should never see a situation where the higher lows in uptrends and lower highs in downtrends are violated. Number 2. The wave 4 should retrace less than 100% of the wave 3. The same logic applies here as with the case in rule number 1. Number 3. Ideally, wave 3 should be the longest of the 5 subwaves, and it must not be the shortest compared to other impulse waves. It should also extend beyond the peak of the first wave. Let me explain the psychology behind each wave I described so that you better understand why the rules I just talked about are important in this process. Wave 1 does not really change any dynamics of what was happening during the previous trend. Many in the trading community still take the same actions believing that the previous trend is intact. I'm talking about actions such as shorting on retracements in a downtrend and buying pullbacks during an uptrend. However, the notable difference here is that volume suddenly starts dropping, which should be the first hint that a reversal might be in play. Professionals who notice this change usually start reducing their positions in anticipation of a trend reversal. Wave 2 is basically a continuation of uncertainty when half of the market participants believe that a new trend might emerge, while the other half still expect the continuation of the trend that took place right before the first wave formed. During this period, low volume and volatility can still be observed. Wave 3 is when things start to change. As soon as the price takes out the area where the wave 1 peaked, the belief that a new trend finally emerged gains traction. This period sees a broad participation, which creates a high volume situation. The common market price actions such as gaps and breakouts in the direction of a newly established trend can be observed multiple times. This is why in general we expect the third wave to either last the longest or at least produce the biggest directional price move out of all 5 waves. Wave 4 compared to previous corrective wave 2 tends to produce sideways moves that prepare the market for the 5th and possibly last move before the reversal finally happens. Since this activity takes place late in the cycle, some of the laggards in the overall market tend to hit their peaks before starting to reverse. Wave 5 is usually the last period in the cycle during which the euphoria and optimism among the general population is at the highest. This period is usually accompanied by lesser volume and high risk of reversal. People tend to risk the most money during this time because of the perceived notion that they might miss the boat. This is the most dangerous period in the cycle when amateur traders and investors lose the most money. Now that I've covered the psychological aspects, let's continue discussing the theory. So far, we've established that a motive wave consists of 5 subwaves, 3 of which are called impulse and the rest are corrective waves. Now it gets a little bit more complex because each subwave also consists of several smaller waves. To be precise, the impulse subwaves can have 5 waves each and the corrective subs can have 3 waves. This is why this type of pattern is called 5-3-5-3-5 structure. To put it another way, imagine that we can identify a major motive wave to the upside on a monthly chart. If we zoom in the same area by switching to a weekly chart, then we can see better the impulse and corrective subwaves that created the motive wave. Drill further down on the time frame and you can definitely notice that these 2 types of subwaves themselves contain smaller waves that I described earlier. The point I'm trying to make here is that no matter the time frame, the similar wave patterns can appear on any time frame chart. This is why Elliott waves are fractal in nature. What this means is basically each smaller part of the whole structure has the same statistical character as the whole. Basically, they look very similar. To make it easier to understand, think of the fact that similarly structured support or resistance areas can be found on any time frame chart because there are always people who participate in the markets, be it a 1-minute chart or a weekly chart. No matter if you are a scalper, day trader, or a swing trader, you would always want to short near resistance and buy near support. Now let's talk about the corrective waves. This is the second half of the full Elliott wave structure. Generally speaking, these are shorter moves created by the market that produce opportunities to initiate positions that are aligned with the major trend. Although the structure of the corrective waves vary based on different market conditions, the generally accepted model consists of 3 subwaves. These waves are labeled with capital letters A, B, and C. Since the corrective phase itself is basically a shorter-term counter-trend price activity, we can assume that the impulse moves A and C can be considered emotive in nature. The wave B, on the other hand, can be characterized as corrective, regardless of the fact that it moves in the direction of the major trend. Similar to the first part of the Elliott wave structure, each wave in the corrective phase also consists of further multiple subwaves. The waves A and C include 5 each and the wave B 3 subwaves. Hence, this pattern is labeled 5-3-5 structure. So if we combine both motive and corrective waves together, we will have a complete Elliott wave cycle. You probably noticed that the diagram I was showing you so far is the representation of the bullish cycle. Specifically, 5-wave advance to the upside followed by 3-wave correction. Since this is an uptrend, the corrective phase must be shorter than the motive. Because the corrective phase is basically a pullback situation, this enables traders to join an uptrend at a better price entry near a support area. In bear markets, on the other hand, the situation is the complete opposite. We can observe a 5-wave move to the downside, which is the motive part, and the 3-wave correction phase to the upside. The correction in this situation enables short traders to sell at attractive price points near a resistance area. The hardest part of trying to identify Elliott wave pattern is the fact that in real life charts don't look exactly the same as diagrams in the presentation I've showed you so far. There can be many variations and therefore it's a highly subjective topic. Some traders will ignore this theory because of its inconsistency and some will swear by it. You really have to decide on your own if you would like to incorporate this into your trading strategy. Let me give you some examples of how the price activity on real-time charts can differ from the main model. In the first example, we have a situation when one of the impulse waves can have a very extended price move. Therefore, the model might not look like the standard Elliott wave structure at all. However, this anomaly can still be considered as normal and it's called wave extensions. Take a look at the daily chart of SPX. The 5th wave is very extended compared to other waves. This throws people off because it doesn't really look like a normal Elliott wave formation, right? However, if we apply the 3 rules I mentioned earlier that checks the validity of the motive wave, we can come to a conclusion that this is indeed the Elliott wave structure. In another case, we can observe a phenomenon called truncation. In this scenario, the wave 5 basically fails to finish above the peak of the wave 3. The reason can be an abrupt change in the sentiment followed by an early reversal, or it can also happen because of some unforeseen news events and so on. Although this will change the structure of the Elliott wave cycle a little bit, it will still be considered valid. In the third example, we can have a totally flat correction instead of a normal downtrend looking one that I've shown you earlier. This can occur if the major trend is very strong and there's not much room for a deeper correction to take place. This can further confuse people who are trying to spot the Elliott wave pattern on a chart. These were only a few examples of the deviations from the normal model that you might encounter while analyzing the price. There are obviously more, but I think you got the idea why the Elliott wave theory can get quite confusing and controversial at the same time. It definitely takes time and practice to become comfortable using this particular indicator. Now in my case, I use it for the purpose of trying to predict when the reversals might happen. If you take a look at the SPX chart on the daily time frame, you can see that the Elliott wave definitely predicted the reversal of the downtrend that we had in 2022. If you take a look at what's happening now, you can see that we're in the fifth wave of the motive phase. It is definitely getting extended, therefore I'm waiting for a signal that the corrective phase has begun. This would definitely give us a chance to initiate long positions on a pullback since we are in a possible bull market as of right now. So is Elliott wave theory worth studying? I definitely believe so, because in many cases it has the ability to predict possible future price changes with a good accuracy, as you've seen in the last example. However, this tool is also very controversial and many traders avoid using it altogether because of its confusing nature. If you found this theory interesting, then I definitely suggest you study it further because there's so much more information available out there online. Guys, I hope you now have a basic knowledge about the Elliott wave theory and learn how it can help you in your technical analysis. In the next video, I will discuss with you the next indicator in the series called Average True Range, or ATR. If you like this video, please make sure to subscribe so that you won't miss any new content. Guys, thank you for watching and I will see you in the next one. Cheers!